Hi everyone, thank you all for tuning in. My name is Madi Daleiden, and I am currently a senior and student analyst in the Applied Investment Management program at Marquette University. Today I will be presenting Five Below Inc., ticker FIVE, which is trading at $186.95 as of market close on September 28, 2021, and has an estimated price target of $249.76. To begin, Five Below was founded in 2002 and went public in July 2012. It is currently headquartered in Philadelphia, Pennsylvania. Five Below is the fastest growing omni-channel discount specialty retailer targeting the preteen and teenage demographic. It currently operates 1,121 stores in 39 states, with 15 more stores expected before year-end. Given the company's name, its products are typically priced between $1 and $5 and fall in one of the 8 product worlds listed below. Because of its strong yet sustainable growth profile, with stabilizing revenues and expanding margins, and opportunities to benefit from secular tailwinds, it is recommended that Five Below be added to the AIM Small Cap Equity Fund with a price target of $249.76, which represents an upside of 33.59%. Top-line growth is a centerpiece of this thesis, as revenues have grown at a 22% 5-year CAGR, which is quite an anomaly for brick-and-mortar retail these days. This revenue is primarily driven by increased volume, or store count. Therefore, it is expected that revenues will decelerate and normalize to the low teen percentages as increased store numbers dilute geographic markets. It is also important to note that same-store sales growth has been positive every year, with 2020 and COVID-19 impacts as the only exclusion. Justifications for these stabilizing revenue assumptions can be found in the blue box to the right. Moving on to the drivers of this thesis. Driver number 1, shop till you drop and scale till you prevail. Increasing store count is the main driver of Five Below's growth strategy, which has been reflected in the company's high revenue growth rates as previously discussed. Store count grew at a 20% CAGR from fiscal year 2012 to fiscal year 2020, despite the COVID-19 impact. It can be expected that growth will decelerate a bit going forward with an 11% store count growth CAGR through fiscal year 2029. Stores have been proven successful across markets from Fifth Avenue in New York City, an extremely urban environment, to rural towns like Lake City, Florida. Despite their location, the average ROI on a new store is 150% within its first year. Five Below maintains a long-term goal of building its store network to reach 2,500 in number. This model suggests that Five Below will meet this long-term goal by the first half of fiscal year 2029. Driver number 2, high five for operational efficiency. Given the subsector's lack of pricing power, efficient operations are paramount for discount retailers. Five Below's industry-leading turnover ratios suggest strong business management and consequently support expanding margins. Five Below boasts a 1.71 times asset turnover ratio versus peers' 1.66, and a 4.56 times inventory turnover ratio versus peers' 3.82. The graphs on the right detail the impacts of these efficiencies and high turnovers on margin assumptions going forward. Five Below's build-out of supply chain scaling systems and infrastructure supports this high turnover, as they opened a new distribution center this year, with plans for another one to open in fiscal year 2022. Driver number 3, teenage dream. Five Below is the only pure-play discount retailer focused entirely on teen-centric products. Therefore, Five Below benefits from favorable secular tailwinds encompassing Gen Z, and it is positioned well to capture this generation's demand. Bloomberg estimates that Gen Z spending power has amounted to $143 billion, and they are now the largest consumer cohort. It is important to note that Five stores were entirely built with preteens and teens in mind, which is evident once you walk in. Given Gen Z is a digitally native population, Five Below also actively works to market to them via social media. Five Below has the largest Instagram and TikTok following versus its operational peers, as well as many active partnerships with social media influencers like esports gamer Booga and author Andrea Pippins. To reach an intrinsic value per share for Five Below, a 10-year DCF model was created. Using a terminal growth rate of 1.5% and a WACC of 6.75%, an intrinsic value of $246.10 was reached. A screenshot of a sensitivity analysis is included below. Additionally, a fiscal year 2023 estimated PEG ratio was calculated using a weighted average peer multiple of 0.91 times, resulting in a relative valuation of $288.35. Finally, a fiscal year 2023 EV to sales per store multiple was calculated using a weighted average peer value of 3.88 times, resulting in a price target of $228.23. By weighing these models 70, 15, 15, a price target of $249.76 was reached, representing a 33.59% upside. On to a few risks. The first risk I identified regards Five Below's supply chain. As with many retail companies, there have been issues with COVID-19 related backlogs and shipping container shortages. However, discount retailers' limited pricing power makes them especially vulnerable. The bear case suggests that continued issues may interfere with Five Below's ability to capture 4Q holiday spend. Notably, the fourth quarter makes up approximately 40% of annual revenues given the firm's seasonality. Second, Five Below prides itself on offering trend-right products, which are heavily reliant on its ability to gauge consumer preferences and habits. This is also important given these products' short life cycles. Unsuccessful product launches may damage stores' relevance and brand image. A third, more near-term risk is Five Below's ability to comp its comps. The pandemic-induced rebound in demand inflated fiscal year 2021 performance and year-over-year growth rates. Therefore, fiscal year 2022 revenues may decelerate as growth normalizes post-pandemic. This horizon may deter short-term investor sentiment and consequently drive down the stock price. Finally, I'll touch on management. Joel Anderson currently serves as Five Below's president, CEO, and board director. He has been with the company for over 7 years after working in senior vice president roles at Dick's Sporting Goods and Toys R Us. Other members of the management team's previous experiences are also included on this slide as a testament to their qualified leadership. 2.35% of all shares outstanding are owned by management and the board, 37% of its senior leadership is female, and management's average age is 59 years old. Finally, one of Five Below's co-founders, Tom Velios, is still active within the company and serves as the non-executive chairman of the board. In conclusion, as Five Below scales its network to 2,500 stores, continues its operational efficiency and margin expansion, and capitalizes on the Gen Z demographic, I recommend that the AIM Small Cap Equity Fund purchase Five Below Inc. with a price target of $249.76, representing a 33.59% upside. Thank you all for taking the time to listen to my presentation. I look forward to answering your questions via the D2L discussion post, email, and/or during the live Q&A session this Friday, October 1st. Thank you.